Thank you for joining iMeet. When you hear the tone, you will be the 29th person to join the meeting.
Sure.
This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Today we're going to quickly review the last couple of days, try to figure out what's going on with this market as we're having a blow-off rally today, Dow up about 200 points. And then we're going to look at some different sectors, go over some key charts I think you need to keep on your watch list. If this is your first time here, I usually talk about 20-25 minutes, and we open it up to questions about individual stocks or sectors or anything that we've talked about, and we hope you get something out of that. Also today we're going to talk about negative divergence and what we want to be looking for as this market just gets so overbought that it gets to the point where we have to have some kind of pullback, and maybe how we can get some hints as to when it's going to start. Okay, already we've had a market melt up now for several weeks. We've had, here's the Dow, you can see this break it up over here. We actually have, we're up six weeks in a row. We had a record close 5 days in a row last week. The thing was overbought about a week and a half ago. We had the S&P short-term oscillator hit 5, which is about as high as it's been. And I mentioned last week in my article with the Schwab's Active Traders that there's one of the things that I track is you know, how far away from different moving averages the different indexes are. In this case, it was the S&P 500, which we'll look at in a minute. But back in March, the S&P 500 got up to 9% away from the 200-day moving average. Normally, it's it's going to get up around 4 or 5% before it starts to pull back. And if we get over 9% here during earnings seasons, that's going to target, I believe, right about 2,600 on that on the S&P 500, and I think it was going to target. If I have my right, something like 24,000, I believe, or 23.8 or something like that on the Dow here over the next week or two. So I still think we have a little bit more upside to go. Wasn't expecting a 200-day jump in the Dow like this, but of course it's heavily weighted, and some of these stocks that are reported industry like Caterpillar and stuff. It was Caterpillar and 3M today are accounting for almost 120 points in the Dow. You still have only about half of them are up. So a few things we want to look at. Okay, so right over here last week we had the Dow cross over 23,000. That threshold broke yesterday, but we're back above it today, punching out another new high. We had the CTI, which actually went from a plus 11 down to a plus 6, which will happen this week. We had the momentum index last week slip to a neutral -1. We also had a negative -1 in the sentiment indicator. So we are starting to see a little bit of slowdown in some of the momentum of the broader market and that type of thing. Now, the reason the momentum index, while we're punching out new highs, is going down is because when the underperformance of the Dow Jones compared to all the other indexes and the AD line and that type of thing. So if you get the Dow where it's up 2% for the week, but then you look at the Russell and the NASDAQ, we were only up 0.4%, and I think the S&P 500 was up just under 1%. So that causes a negative momentum in our market posture. Okay, we had also as far as the sentiment goes, we're still a little bit too bullish on some of these things that we look at. We had the percentage of bullish investment advisors is back in the danger territory above 60%. That means the reason that this is a contrarian indicator, and the reason being that if everybody's already, all the professionals are already in the market, you're going to lack the funds to push it higher. That has been the danger zone for most of the year, actually, and we only have about 15% of the advisors are bearish, which is not a record low, but it's certainly down where it's, you just can't find any bears out there. We also had the fear and greed index, which is when it reaches extremes, you want to keep an eye on that. And we actually hit 90 on Friday, where the thing was jumping up. So the Dow and S&P or 500 are still overbought on just about all levels, but we are seeing some consolidation in some of the other indexes, which is good. We want to see that. We don't want to see this thing just blow off up to the top every day and just have a complete meltdown. So I think the S&P short-term oscillator right now, as of yesterday, was 3, which is good. With some of the other indicators like the 14-day RSI and 30-day stochastic, we're overbought on the Dow, obviously, and the Nasdaq and S&P, but we did get a little bit of a consolidation in the Russell 2000 and also the Dow Jones Transports. Now here's the NYSE Advanced Decline line, which is from the market at a glance on the website. Again, you can see this rocket shot. We still have good broad participation in the market. This is still bullish. Generally, this thing's going to roll over probably a month or two before the whole market would start to pull back. So this isn't giving us any divergence in that yet. We still have good participation in the NYSE and Nasdaq 52 new week highs and lows. Nasdaq is starting to contract a little bit more, but the NYSE is still pretty good. We're about 150 today. So, we're seeing some contraction, not enough that I'm going to say it's divergence yet. This is divergence when you're starting to make new highs. You're getting more new lows than you are new highs. So we'll keep an eye to see how this starts to contract. We have, here's the S&P 500. Again, we have these upward channels that are going on here, and the S&P 500 is a little bit overbought. Here's the 14-day RSI. It keeps moving up. I like to keep the 30-day stochastic above 80 to show a strong trend, but when it gets about 95, 96, it's just too overbought, and you're due for a little bit of a pullback. However, it doesn't happen. Like Yogi said, it ain't over till it's over. So we'll just keep on going with this thing for a little bit. But I still think the S&P 500 probably can get to about 2610, I believe is what I wrote last week for Schwab's active clients. Here's the Nasdaq. Again, we have this thing, this upward channel again. A little bit of negative divergence in the MACD, nothing much. You're kind of working off your overbought condition on the 14-day RSI, and also you're still overbought on the 30-day stochastic, but accumulation is still good. You can still go up on this thing. I think on the Nasdaq, my target is 6670, something like that. So I think we'll still probably get another push here either this week or next week before we start seeing some problems with that. Now here's the Nasdaq AD line. You can call this negative divergence, but I don't think it is yet. Today we have about 300 more units advancing and declining, but we want to keep an eye on this thing. If it starts to come back down here where you start to see it roll down to here, that would be a little bit of a red flag. Next, we have the new highs in the Nasdaq versus new lows. You're contracting a little bit, but nothing I'm really worried about. Now today you're only at 96 new highs, so that'll bring this line back down to here. So, and we also have about 50-some new lows. So we'll keep an eye on that. That's a little bit of negative divergence after today if this thing comes back down to here. So we'll keep an eye on that as far as what we look. Now here's the Russell 2000 Small Cap Index. It's one of the beneficiaries of tax reform, the small caps. There are a couple different ways you can look at this. We were very overbought, and now we're getting this sideways to down action. Could this be a flag? Possible. If it's a flag and we get a big breakout in that thing, you're probably going to get a run up here to 1550, 1560. When you have a big push like this, where you've had about a 10-11% move, there's a lot of discussion with different people. If it was a breakout from say here, then you would take the flagpole would be from here to here, and then measure that, then take it up to here. That's going to give you the 1550, 1560. But some people would say, okay, well, this is the start of the flagpole. I don't really agree with that. I think this is just some consolidation. So I'm taking the flagpole starting from right here. This was just a bounce back from that little sell-off that we had in August. That was the last time the CTI was negative. Anyway, so you had this overbought region over here. As long as this 14-day stays above 40, you're in a bull trend. So this consolidation is actually very welcome. Let's get this thing to see if we're going to have another blow up to the upside. Here's the transports. they also are kind of consolidating some of these gains. Good accumulation down here. You had a little bit of this pullback. You had the MACD go bearish, and you're getting ready to go positive again on this. You're up a little bit today. Breakout above 10,000 probably is going to be another indication that we're going to get that last spurt up, and I still think that probably happens here over the next week or two. Okay, one more over here last as far as the indexes go. Here's the semiconductor index. You see this channel was going up, today coming back, went up to the back, started to come back down, then we broke out of the upper channel again. A little bit of divergence in the MACD again, but the new highs and the 14-day RSI is offsetting that, and being above up here at 94 just shows it's overbought. I'm not looking. This isn't any sign that we're going to be having a pullback in the stocks. In fact, here's the technology select ETF XLK. And again, good accumulation. This looks good. I think you get another positive of this. If you stay in this upward channel, you can probably get a little bit moved. Now, this doesn't have this has semiconductors, but it also has software, networking, that type of thing. So there's a lot more to technology than just the semis. Although the semis have basically been the leader. So anyway, what I want to look at next is before we get talking about negative divergence. Last week, the best performing sectors were healthcare, up almost 2%. Utilities, which still look strong in here. Financials, they still have a ways to go. And materials, which, of course, when you're building things out, you got to have materials to build them. So those are the top performing indicator sectors. As far as on the downside, you had consumer staples were down about 1.34%. Energy was down about 1.25%, and consumer discretion was also down on that. So what I want to do in here right now, we're going to go over a couple of the different sectors, and then we're going to talk about the change in the CTI and the negative divergence and some things, and a couple of charts that I want you to keep on your list of things to check daily. The first thing I want to look at is the financials. You can see this channel that we were in, up and down. We broke out of here, consolidated, and we gapped up here last week, towards the end of the week, as the yield on the 10-year Treasury went up to about 239. Today we're at 240. Yeah, 241 today, so we're still getting higher on that. We were a little bit great accumulation on the financials right here. Some people think that it's because of they actually have a double whammy as far as why they're going up. The banks are highly taxed. They can tax reform would allow them to come in stronger with their profits. Also because as the yields go higher, they make more money, especially on the dividend spreads or the yield spread. But financials, I think, can still go higher. We talked about through here how you wanted to buy them all through pullbacks, and they would probably be leading the next advance. That rotation has been happening strongly. Again, when you see the advanced decline line surge up like this, that's institutional money. They're still buying that. The XLF is now just about where it was back in 2008. As we started to correct, so you have more upside to go in financials, the banks and insurance companies, that type of thing. And I think that you don't want to just keep chasing them right in here, but on any type of a dip, when you see your Bank of America and your First, Third, FITB stocks like that, BMA for foreign stocks, don't just limit yourself to the banks here in the States. We talked about BMA. I think it's an Argentina bank a couple of weeks ago. It's up about 14% since we talked about it. You want to look overseas at some of these banks too, because their yields move up. They're at a lower valuation in some of their sectors than we are, and they're just beginning to start the process where they talk about raising rates. So some of these foreign banks are going to be something that you may want to pick up here if you kind of miss some of our banks. But XLF, I still think if you're in there, you still want to hold it. Another one that we have, one more thing over here on this, on the financials. We're going to look at the U.S. dollar here in a little bit. We're going to look at some of the treasuries to see where we think a breakout can happen. If we get the yield up to about 2.6, and we're at 2.41 right now, that would probably mean that the financials would be up here around 27 and change. That is probably the inflection point that's going to cause some of these stocks to at least temporarily stall. So we'll keep an eye on that later on these charts. But for right now, I think you still have some upside to the financials. Okay, industrials, we're getting a big push today with the Caterpillars and this 3M. They're still going. You still have this weak dollar, which is good for multinationals. It means when they make their money overseas, they don't have to face currency risk, that type of thing. Again, we'll keep an eye on the U.S. dollar for industrials, but they're also leading the way up. Good accumulation into this thing. Overbought. They're all going to be overbought. This is kind of interesting here at the MACD because you have a little bit of negative divergence, but that to me isn't really going to be negative divergence. It's basically just working off an overbought condition over here. But this is going to, you're surging up in the XLI today, overbought. Again, that's part of that is because of the Caterpillar and 3Ms on that. But this is one of the leaders. The weaker dollar is going to help that until the dollar gets up to around almost 20. The UUP gets up to about 26. You still have plenty of upside on the industrials. Another one of the leaders is materials. Again, the economy's buzzing along. These companies are building. They need materials to build with. This will include, steel stocks, which were long in this pro sector portfolio. Again, here's the rotation into the materials. They were kind of going sideways here. Now you're getting a big accumulation. That's institutional buying. Again, you're overbought, but when you're having moves like this and this much money going in, you're going to be overbought. Again, this is a little bit of consolidation in this area, but I think the materials, again, they're affected by the U.S. dollar, but the dollar is still weak enough right now that you can still have some more upside in that. So good place to be still on some of these stocks. Utilities was one of the top sectors last week, the second best performing one. Here's its upward channel. You still have some upward movement in this. I've been, so over this where a little bit negative on utilities, partially because I think as yields go up, you will have a little bit of slowdown in this. You don't see the accumulation in there, but you do still see some accumulation. And so these still have some upside. If I'm long on utilities, I'm not looking to get out of them. I'm holding. I'm not trying to buy more than but I do. You can hold them until the yields get up to almost 3. Okay, now I want to take a look at the healthcare sector. XLV, it looks strong, but we're going to start to see our first signs of some negative divergence showing up. A lot of it's going to be due to the biotechs, but you're still getting a little bit higher highs, a little bit higher lows. You're having a weak day today. In fact, the biotechs are down today over 1%. So, pharmaceuticals down about 1%. The biotechs are down. They were down about 1% earlier. Not exactly sure why this is. We're having so much problems with the healthcare sector. I actually did some studying for this, and I didn't really find anything unless it's just that they keep talking about new. They still try to bring up the healthcare reform, and maybe that's kind of putting a lid on this thing. But again, remember how we saw the big jumps up in the accumulation distribution? You're just seeing some kind of meandering a little bit higher on here. You're working your way off here on the 14-day. You're getting a little bit of negative divergence. You're making a new high, which isn't confirmed with this. And you're also going to have the full 30-day stochastic go below that. So healthcare is although it's up, it's showing the first lagging the others enough that you want to start to have some concern on that. Now here's the IBB. It's the iShares Nasdaq Biotech ETF. We're really struggling over here. You're back down here on the 14-day RSI down around 30. And as you know, once when we talk about Connie Brown on her studies with the 14-day RSI, when you fall below 40, that generally means that that you're going from a bullish trend to a bearish trend, and we're down here around 31 today on the 14-day RSI, which means that as long as it stays above 40, the uptrend is intact. And you also had the 30-day stochastic breaking below 20, which is another thing that with the downtrend is actually strengthening. You also have this, you don't see the big, strong move up in this. In fact, BBH was one of the sectors in our pro sector fund that was in there. We sold that out here on Monday for about a 6% gain. We also sold out GDX in that portfolio. We added USD, which is a double semiconductor ETF, and we added PSJ, Paul Sam Joe, which is a software ETF to take the place of the GDX and the biotech. So I'm on the sidelines here a little bit for the biotechs. Of course, there's going to be individual ones that go up that you want to watch. I think that if they have a strong trend, you can still go into them for a longer term. But I think that we may see some struggling here. I had a question on Guild Sciences over here. Again, as of now, you're still above 40 on the 14-day RSI, so you're still in a bullish trend. These flag patterns generally aren't going to last more than about 4 weeks. This is getting close to that. You want to watch this to see if we're going to break out to the upside or downside. You're not really getting any hints. In fact, if Guild breaks below this 78, 75 area, you may get a pull back down here to the 50% retracement, which would be down around 74. So you're going to keep an eye on that. Today you had a sell-off down to the bottom channel and a reversal back up to the 50-day. It's struggling on that. It was holding until today, so we'll see if Guild can keep business with that. But you're also again, this is as I say, you're getting a lot of selling in the thing, but you're not getting a lot of buying. This is just kind of indecision, and we'll have to see which way this breaks. But if it breaks below this channel, you're going to get some more selling in that. So if you're long, I would be, probably putting in my support. That this support here is 78.25, something like that. I would probably let it go around that position. But this 50%, this other around 70 something down here would be where the downside target could be. So keep an eye on that. All right, a couple of them real quick. Other charts I want to keep a look at. This is oil. You're sitting up here. We talked about our we've been pretty bullish on oil up through this period. We thought our upside target was going to be 52.50 with an outside chance that we could get a surge up to about 55. That's still the game plan. If we can bust through this, we're at 52.50 right today. We're up 1%, so we're bumping up against this resistance level. I would watch this thing in here if we bust through this with some good volume. I would maybe add it, maybe buy a little bit more. If we can't get through that, we start to roll over and take out this pivot and go below 50 on the crude oil. I'm probably going to suggest that maybe you take your profits. As we struggle up here sideways, if you want to take partial profits in that, because you should have some pretty good runs in this area. We've had a pretty good 4 or 5 weeks in the oil. Still good accumulation. This makes me think that we may get a little bit more of a chance to pop up. But if we don't, then $50 is going to be where you want to keep an eye on as far as where maybe this little bull trend here is broken. But we're still bullish until that happens. And I guess, again, if we break this 52.50 with some oomph, you can get another little surge up here to the 54 area, where I would be a seller of my oil stocks. Okay, one last one here. Now, this is energy, which you're also getting a little bit of a pullback now. Is this going to be a flag? I don't know. This again, it's indecision here as far as people buying. This was when we got a little run up in oil, had a nice move in the energy sector, but now we're starting to get a little rollover in the indicators. We broke 80 on this thing, and this is just indecision by the buyers or sellers. It's probably going to take a break above 52.50 on oil to get this thing another leg up. So we want to watch to see if this little flag channel breaks to the bottom or the upside. Watch the accumulation distribution. If this thing starts to get a leg up, then we'll get that running in oil to 55, and you can hold on to for the trade to that. But right now, I'm holding on to what I have as far as energy, maybe scaling back a little bit on some profits, and but I'm not going to add the positions in here by any means. Not even the Halliburtons or Schlumberger on pullback. So keep an eye on that stuff. Okay, another chart I want you to keep in mind is this one. This is TLH, and this is the iShares ETF for the 10-20-year Treasury bond. As you can see, this is kind of interesting. Now, this is the bond itself. So as this goes up, that means if this goes up, yields are going down. When this thing starts to go down like it is right now, that means yields are going up. Now, we broke a pretty good trend line that went back in here into May. We sold off. We rallied back into the trend line, which also coincided with the 50-day moving average. So that was a double resistance point on the thing. We came over here, tried to hold the 100-day moving average. Was unable to do that, and now we've broken down here. We're going to test the 200-day moving average, which would probably put the 10-year Treasury yield somewhere around 245, that area 245, 250. Again, once we get to 260, that inflection point is going to be where I think you're probably going to have some problems with stock, with the broader stock indexes, and that's we can keep an eye on that. Whether you look at that, the 10 years is going to be the key to that. Now that's one side. Again, it's going to help the banking stocks and a few other sectors, but not the broader market. I think it'll cause us to kind of stall a little bit. Now this thing here, you see they're buying this dip in here again. We'll see if that's whether this thing's going to hold or not. If it holds here at around 250, 245, 250, as far as the yield goes, the market can still go higher. But 260, you want to keep an eye on that, and then keep that chart in your lessons here. Now, UUP is the ETF for the U.S. dollar. All through here, we were talking about how this is going to be good for emerging markets, good for industrials, right, but good for the general market. We had a $24 target on that thing, which was right around here. We actually overshot that to the downside, went down to about 23.75, right over here. Okay, now we've broken this upward trend line. We are at resistance over here at the 100-day moving average at around 24.40. Today, let me check something real quick. See where we're at on that today. Okay, it's up over 24.42 right now, which is right in here at this 100-day moving average. If we break through that, now there's a lot of lines on here. Some of these are just are resistance lines, but the 50% retracement from back here in March 1st down to where we were here in September would allow this dollar to break up to here to about 25.10, which would be the 100-day moving average. That's for the UUP. That also is probably going to indicate that if we get to that, you're pressing that 2.60 on the 10-year, and that's again where we're at an inflection point. If we get above that, we're going to have some problems with the market. So keep an eye on that. You're not getting a lot of buying in this thing, which is good for us. So which means that that right now the traders or currency traders look at this thing maybe to go sideways and kind of struggle with the 50-day. If you were seeing this thing really start to move up on accumulation, that would mean you're going to have the traders are looking for a higher dollar. They're going to buy it. But on the plus side, even though we've come back in here to this 24.40 area, you are starting to get a strengthening in the euro, which is good as they start talking about raising rates. So that's going to be you're going to need to kind of keep an eye on that. As long as the euro stays strong, we're in pretty good shape with this dollar, and that'll keep our yields in where we want to try to keep them. Okay. Now I want to talk real quickly before we get to some questions. So if you have your questions, go ahead and start putting them in. I see we got a couple coming in here. This is where we stand with the CTI. Now, for those that aren't familiar with that, the CTI is a cyclical trend index, which is tied somewhat to the business cycle. It goes in and out of the market. When we get a negative CTI, it means we're neutral on the market to bearish. Last year, trading the CTI, going long and short the just on not leverage or anything, we were up about 25% versus the Dow being up 12% or something on the S&P 500. And then this year we're up about 4% versus the the S&P being up about 13, 14, and the Dow being up 18. The main reason for that is, there's three reasons. Number one, we were bearish going into the first of the year, and we lost about 800 points, which caused us to be negative for a while. Secondly, when we went to two periods of neutral to weak periods, the transports and the Russell 2000, even the S&P 500 traded down to sideways. However, this is the year of the Dow, and the Dow we lost money on the leveraged trades all year long, and even though sometimes we had a profit in the CTI going bearish with the Dow, by the time we flipped it over, which we do on a Friday of every week, the Dow is back up, and then we lost money on the trades. But as you can see right here, this week we'll go to a 6 on bullish. We stayed bullish up through November 10th, at which time cycles B and D will both go negative. So we want to kind of keep an eye on this. Now, if the momentum index that we have stays positive, then we'll just be neutral on the market, and we can stay neutral until the first of the year. It all depends on how the momentum index and what happens. What I look for on that and sentiment index also is if we start to see the other indexes start to outperform the Dow, and they maybe catch a little catch-up ball, or the Dow Jones starts to roll over a little bit to kind of revert to the mean, where it would just be a market performer with the other indexes, we could stay neutral. But if we all start to crack some of the support zones, then we could look for a little bit of a pullback. Nothing big, nothing like a 10% or anything like that. But I still think you can see some weakness, just mainly from an overbought market. Also, when you have money managers that are up, hedge funds that are up 20% this year, one of the last things they want to risk with a month to go is to see the market all of a sudden pull back 5-6%, and they're stuck with it, and they've got to go out, go into cash, and they turn a great year into an okay year. So normally this is a bullish time in the market, but the way the cycles are running right now, it looks like we could have the rally could stall a little bit. Earnings will pretty much be over by this time, and this is going to be kind of when the debate with tax reform may be in full swing, and that probably will influence what the market's going to do. So, when we talk about the negative divergence, I almost wish we would see some negative divergence when the market's just having a melt up like this. But at this stage, I don't see any really worth talking about. Just the fact that the broader market is underperforming the Dow. That's a little bit of negative divergence, but mainly it's just meaning that the momentum has slowed a little bit. So what we're trying to do is over the next week or two, we're going to keep our eyes on some of these charts that we looked at the end here to see if we're starting to see anything at all break down. As far as I see over the next couple of weeks, I'm not going to be aggressively chasing anything. I'll buy some stuff, but I'm not going to. I'm not jumping out yet. Now, as far as some of the portfolios that we've talked about, I had some people calling about these things that we're going to be rolling out after the first of the year. This week on Monday, when we do all our buys for the model portfolio, we bought GM. We also bought the semiconductor company LRCX, Lam Research, and we also bought URI, which is United Rentals. In our aggressive growth, we bought a company, the symbol is AXGN, which is a biotech, I know, which we're kind of neutral on, but the outperformance, relative strength on that went in. Another one we bought is for income and growth. For the more conservative plays, we bought American Software. The symbol is AMSWA. And on small cap growth, we bought a company, the symbol is ACLS. They're a chip maker, and those are the new additions into those portfolios. I'm not going to tell you what we sold because we, hopefully you're just starting to add to some of these positions. Okay, we're going to open up to questions right now. I finally got in when this says, okay, would HEDJ be a good choice? I think that's the hedged Japanese fund. If it is, it's going to be. I'll take a look at that real quick. Your new site is fantastic. One ad would be a list of all stocks that are strong buys. Okay, Frank, when you go to stock analysis or trading ideas, if you go under stock analysis, look under best longs, and that is going to include about 95% of the strong buys. The strong buys that aren't included there have moved too far away from a short-term moving average, and that's why they're not included. They're in that list. It just means that they've ran too fast, too far too fast. I want to see that so they can come back on there, but it may be a strong buy, but we just think there's a little bit too much risk in that. Okay, finally, Bloomberg and other sites keep talking about the upcoming crash. If you're not buying whole, what is your advice on when to get out? Okay, well, that's kind of what we talked about today. We're looking for the negative divergence. We don't want to give away 20% of these profits or anything we have this year. So we're going to keep an eye on cracks in the armor. I hope you join us the next couple of weeks because with the fact that we're going to have a negative CTI coming in, I don't see a stock market crash anytime happening right here. There's too many bullish signs out there, and also the fact that you don't see everybody just screaming and flying into this thing, throwing into it. So I don't see any other questions coming at this point. I've gone over 40 minutes, which is longer I want to go. Again, if you have questions ahead of time, please send them in. Somebody sent it on Gilead, so we got to talk a little bit about that. But I hope you got something out of this if you joined us during your busy day. And I think we want to keep our eye on this market pretty carefully over the next 2 or 3 weeks. You're going to have a little bit of pickup in volatility as earnings come in. A lot of that is because they're going to be looking at forward guidance going forward here. What's going to look over for the next quarter? Tax reform is going to be big. They think if that happens, they can add $10 to the earnings for next year on the S&P 500. So a lot of stuff going on. Right now we're being cautious, staying a little bit nimble, but we're staying in the market here, and we're holding on to the leaders and holding on to our winners. So I'll talk to you next week.